What's up, guys, and welcome to the Economic Outlook. With the pandemic of 2020, the US federal government spent trillions of dollars on fiscal stimulus. The result has been an unprecedented increase in public debt. As of July 2021, the US's national debt burden is $28.5 trillion and is increasing rapidly. The public debt to GDP ratio has reached a staggering 127%. This means the government has borrowed more money than the entire economy produces in a year. But what does this debt actually mean for the average American household? Will it have real consequences for the economy and people's living standards? Former Federal Reserve Chairman Alan Greenspan says we never have to worry about a sovereign default because the government can always print the money.
Are U.S. Treasury bonds still safe to invest in?
Very much so. I think this is not an issue of credit rating. The United States can pay any debt it has because we can always print money to do that. So there is zero probability of default.
But this seems a little too good to be true. It's like the US government has an unlimited credit card they can use to borrow trillions of dollars indefinitely. Surely, there has to be some consequences if the debt gets too high. After all, in economics, there is no free lunch. Technically, Greenspan is right. The government has the ability to print an unlimited amount of money to make good on any amount of debt, no matter how big. But if the debt becomes too big, the amount of money that has to be printed will eventually reach a point of absurdity. Surely there will be economic consequences at some point. In this video, we'll analyze the long-term consequences of excessive debt and determine whether the US's current debt load is sustainable. The severity of a given sum of debt must be compared against the borrower's ability to service the debt. For example, let's say you bought a new house with an interest-only mortgage worth $200,000. The interest rate is 5%, so you owe $10,000 per year. If you work in a bakery making $20,000 per year, you will owe half of your salary in interest expense. This is an unsustainable debt burden as you won't have enough money left over to cover basic living expenses. Now let's say you're a doctor making $200,000 per year. The interest payment on the mortgage is only 5% of your gross income, so this debt is easily sustainable. The same basic logic applies to the government. The government has interest liabilities on the public debt. It funds these liabilities by levying taxes on the people. The greater the level of output in the economy, the more taxes the government can collect. The US federal government's interest expense was $522 billion in 2020. While this sounds like a lot, it is only about 2% of the country's GDP. This sum of money seems quite manageable in the context of the government's ability to raise taxes. Thus, the appropriate way to view government debt is the debt to GDP ratio. We must also take into account that GDP is not a static number. If the US economy continues to grow, the government can sustainably run budget deficits and increase the level of public debt. It's okay for public debt to grow as long as GDP grows commensurately and the debt to GDP ratio remains stable. Has the US surpassed a sustainable level of debt? We'll dig into the numbers to find out. In 2020, the government took in $3.4 trillion of revenue and spent $6.6 trillion. The spending was unusually high as it included the pandemic-related stimulus programs. The primary deficit, which excludes interest expense, was $2.9 trillion. Including the $300 billion of interest expense, the total deficit was $3.2 trillion. In 2019, the primary deficit was $0.5 trillion, and the total deficit, which includes interest expense, was $0.9 trillion. 2019 can be considered more of a normal year because it did not include the pandemic. After the pandemic-era stimulus is over, we can reasonably expect the deficit to return back to 2019 levels. But is the 2019 deficit of $900 billion sustainable? In 2019, the primary government deficit was $0.5 trillion and GDP was $21.4 trillion. This means the primary deficit was 2.3% of GDP. We will assume that in the post-pandemic economy, the primary deficit will revert to 2.3% and remain there. In 2022, we assume GDP will be about $22.4 trillion. The long-run growth rate of real GDP will be 2%, and inflation will be 2%, which is the Fed's target. This gives nominal growth of 4% per year. Based on current trends, public debt will be about $29 trillion at the beginning of 2022. The current yield on the 10-year US Treasury bond is 1.4%. We assume the government continues to be able to borrow money at this rate. The pandemic-era stimulus programs will likely be over by this point, and the primary deficit will return to 2.3% of GDP. This gives a primary deficit of $520 billion and an interest expense of $410 billion. Adding these numbers gives a total deficit of $930 billion or 4% of GDP. I simulated the growth of GDP and public debt, assuming a constant primary deficit of 2.3%, a constant interest expense of 1.4%, and a constant nominal GDP growth of 4%. The blue line represents GDP, and the orange line represents debt. Both increase exponentially, but GDP grows slightly faster than debt. At the beginning of the simulation, debt is greater than GDP. But by about 2077, GDP surpasses debt. I also charted the debt to GDP ratio. In 2022, debt to GDP starts off at 129%. By 2190, 170 years in the future, the ratio converges to about 90%, so the level of deficits is sustainable. The reason the deficits are sustainable in the long term is because we assume nominal rate of GDP growth exceeds the nominal interest rate the government has to pay. When this happens, the GDP grows faster than the debt. In fact, if GDP grows faster than the interest rate indefinitely, the government can theoretically support an unlimited budget deficit. Let's take the extreme case of when the government maintains a primary deficit of 10% of GDP. The ratio of debt to GDP increases, but it eventually converges to about 384%, at which point it stops growing. Regardless of the size of the primary deficit, the debt to GDP ratio will always converge to some fixed point. As the debt to GDP ratio becomes larger, the size of the primary deficit becomes less significant in relative terms. At any given primary deficit, there is a level of debt to GDP at which the faster growth of GDP relative to the interest rate will offset the primary deficit, and the debt to GDP ratio will remain constant. Thus, theoretically, the government can sustain any level of budget deficit. Does this mean the government should just borrow an unlimited amount of money without regard for the level of public debt? Well, not exactly. This theory of unlimited debt relies on the assumption nominal GDP will grow faster than the government's interest rate indefinitely. This is a very strong assumption. In the current environment, with the 10-year US Treasury yield at the historic low level of 1.4%, the government's ability to borrow money is almost unlimited. However, if interest rates increase to a more normal level of 3 or 4%, the government will no longer be able to borrow unlimited money. Here is the debt to GDP simulation if the interest rate is greater than the nominal GDP growth. When this is the case, a primary deficit of any size causes the debt ratio to grow exponentially and be unsustainable. With the debt to GDP ratio currently so high at 127%, an increase in interest rates to above the nominal GDP growth rate would necessitate the government to switch from a budget deficit to a budget surplus. This will require either a reduction in spending, an increase in taxes, or both. This contractionary fiscal policy would reduce people's wealth and increase unemployment. If this happens, the Federal Reserve would likely print money to keep interest rates low. This will allow the federal government to continue borrowing money and prevent the need for a painful fiscal contraction. This gets to the point Alan Greenspan made about the government never defaulting on the debt because they can always print the money. Of course, money printing has its own drawbacks and can cause hyperinflation if it is relied upon too heavily. Another way to judge if the US's level of public debt is sustainable is to look at Japan. Japan has the highest level of debt to GDP of any developed nation at 266%. This is roughly double the current debt burden of the US. As you can see from this chart, Japan's level of debt has grown rapidly since the 1990s, with much of this being purchased by the country's central bank. The unprecedented level of debt has not hindered the government's ability to spend money and has not had any direct negative economic impacts. Inflation has been stable in the country. If anything, it has actually been too low, with an average over the past decade of less than 1%. The Japanese government's ability to borrow money is supported by extremely low interest rates. The current yield on the 10-year Japanese bond is just 0.04%. As we have shown earlier, when the cost of borrowing is very low, large debt burdens can become sustainable. The reason Japan's interest rates have stayed so stubbornly low have to do with the aging population and secular stagnation of the economy. This issue is deserving of its own video in the future. The US population is aging as well, so the economic forces keeping Japan's interest rates low will likely apply to the US as well over the next few decades. While the US's current debt to GDP ratio is reaching unprecedented levels, it is not a cause for concern in the short to medium term given how low interest rates are. While the government's ability to borrow money is not unlimited, it is far greater than many people realize. Even if Biden's $2 trillion infrastructure bill is passed, this is unlikely to result in any type of a debt crisis. Alright guys, that wraps it up for this video. What do you think about the US government's debt burden? Let us know in the comments section below. As always, thank you for watching and we'll see you on the next one.